growth rate, about 3.7%. It's way below 6.
Right.
And so inflation will come down. The economy will start slowing down in 2025, and the Fed will get into its loosening mode of lowering those Fed funds rates some more. And I think the dollar will back off from these very strong position that it's in right now. And when that happens, I think that'll be the catalyst for the gold market to really start continuing the bull run that it's in right now.
Due to persistent inflation over the past several years, more investors have been turning to gold as a safe haven asset, and that's worked out quite well. Over the past 5 years, gold has rallied by over 80%, comfortably outpacing the returns for low-risk investment vehicles like bonds and high-yield savings accounts. Precious metals can rise with stock market rallies, but their lack of correlation also enables gold rallies during the market. In this video, SteveHanke, professor of applied economics at Johns Hopkins University, discussed how U.S. policy has driven gold prices to record levels. He emphasizes that gold remains in a bull market despite headwinds from a strong U.S. dollar and steady interest rates. He predicts a slowing economy and declining inflation will push the Fed to lower rates in 2025, driving gold prices higher. Market participants are pricing in near-even odds that the Fed will cut rates twice by the end of 2025, with the first reduction occurring in June. While the price moderated somewhat late in the year, the uptick in gold prices started again in early 2025. The price of gold is now sitting near another record high. According to SteveHanke, the contracting money supply has curbed inflation but has gone too far, slowing growth to 3.75%. He predicts inflation will drop below 2% by 2025, weakening bond yields and the dollar, which could reignite momentum in gold's bull market. Entering 2025, models from forecasting companies like Trading Economics anticipate inflation rates between 2.4% and 2.9%. Unfortunately, predicting inflation can be difficult as rates can be affected by various factors, including political climates and supply chain interruptions. Now we present the clips of SteveHanke's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
It's clearly in a bull market yet, and it's been chopping around a little bit recently. Mainly, it's hit headwinds because the dollar is so strong, and the expectation is that the Federal Reserve will hold interest rates where they are right now for a while, longer than people had anticipated. I think what will happen is the economy will start slowing down. Inflation will continue to go down. And why is that? That's because the money supply right now is still growing at a much slower rate than Hanke's golden growth rate, which is 6%. That's a rate consistent with hitting the Fed's 2% inflation target. And the growth rate now is, right now we've got the growth rate, about 3.7%. It's way below 6.
Right.
And so inflation will come down. The economy will start slowing down in 2025, and the Fed will get into its loosening mode of lowering those Fed funds rates some more. And I think the dollar will back off from these very strong position that it's in right now. And when that happens, I think that'll be the catalyst for the gold market to really start continuing the bull run that it's in right now. Yeah. By the way, one way to actually trade it that's quite profitable, even in a sideways trade, is to use something that Abe Kaufness and I have developed called the Hanke Kaufness Gold Sentiment Index. And what we do, we text mine all the articles that come out every hour on the gold market, and determine whether those articles are bullish or bearish. And so we get a sentiment signal in real time.
Wow.
And when that signal becomes very bullish, what happens is that it always reverts back towards the mean or even towards the bearish side. So if we have a very bullish signal at the extreme and you're long, it swings back and forth. And in a day, you can have, 2 or 3 swings in one day. So we're getting rid of inflation, and we're getting rid of it because the money supply has been contracting.
Right.
My view is that it's contracted too much. They should have let the money supply come down to this 5-6% year over year rate. The inflation would have come down out of the system as it's coming out of the system, and we wouldn't have had the economic slowdown that I think we eventually will have. Now, by the way, the important lesson for the commodity markets here is that, and I think the markets have all this wrong, is that the money supply is anemic in the United States. It's contracted, and its growth rate is anemic right now.
Right.
And inflation will keep coming down. John Greenwood and I predicted at the end of this past year, 2024, we would have inflation at 2.5 to 3% per year. We had 2.9, so we hit it. And we think it will come down to the inflation target of 2% or a little below in 2025. Now, if inflation comes down, bond yields come down, the long interest rate comes down, and that if anything, if all else remains the same, that would mean the dollar would get a little bit weaker, and of course that would put some wind back in the sails of the bull market in gold.
In his analysis, SteveHanke contrasts Paul Volcker's effective monetary policies in the 1980s with Jerome Powell's current approach. Volcker curbed inflation by tightening the money supply but caused recessions. Meanwhile, Hanke observes that Jerome Powell focuses on interest rates while ignoring the money supply, having first expanded it excessively and now over-contracting it. Currently, the U.S. money supply is below its July 2022 levels, signaling mismanagement. However, since the turn of the century, the inflation rate has remained fairly stable, averaging roughly 2.6%, with M2 growing at 3.8%. Most notably, from 2009 to 2019, the average inflation rate was below the long-term average despite increased money supply levels. The Fed is expected to hold its benchmark interest rate steady in the current 4.25% to 4.50% range at its next policy meeting on January 28th and 29th. While the central bank's monetary policy statement may see little if any change, Fed Chair Jerome Powell in his post-meeting press conference will be able to set the tone for the months ahead. Let's get back to the interview.
Well, the biggest difference is that Volcker was a monetarist, and he knew that excessive increases in the money supply caused the inflation that we had in the late 70s. And to wring that inflation out of the system, he knew he had to bring the money supply growth down, which he did. As it turned out, he overdid it a bit because they weren't measuring money properly.
Right.
He thought he was tapping on the brakes just about right, but in fact he was really slamming on the brakes. So we had, in the early 1980s, when I was actually on Reagan's Council of Economic Advisors, during that first term of Reagan, we had 2 recessions. So there was too much slamming on the brakes, but he had the right idea. He was thinking right. Chairman Powell isn't even thinking right. None of the central bankers are. They don't look at the money supply. They think monetary policy is about interest rates. Monetary policy is not about interest rates. It's about changes in the money supply.
Right.
And right now, we've had a situation where they overdid it, and now they're on the upside, and now they're overdoing it on the downside. Now, Volcker didn't have that. When he came in, the Fed had already made its mistake of excessive monetary growth. He was just wringing the thing out of the system. Now, with Powell, we have a chairman who not only has goosed the money supply, and now he's contracted the money supply. The money supply, the stock of money in the United States, is actually lower than it was in July of 2022.
Wow.
It's actually about the same. It's slightly lower now. It's creeping up a little bit, but not as I said.
Few investments did better in 2024 than gold, wrapping up its best year since 2010 and one of its largest annual gains. Wall Street's gold bugs think prices will climb even higher in 2025. Given Hanke's insights into inflation, interest rates, and gold, how do you think upcoming Fed decisions will affect the precious metals market in 2025? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.